Hey guys, what's good? I'm Andre and today I want to talk to you guys about the cash flow wheel and identifying good enough stocks to run the cash flow wheel on. Guys, before we get started, thank you so much for all of the likes you guys have been giving me throughout the last few videos. Honestly, it's been helping tremendously. Being still a pretty small channel, every single one of your guys' likes helps me, so thank you so much for that. Now let's get started here, guys. So what I want to focus on here is first off understanding exactly what we're looking for when we mean an appropriate stock to run the cash flow wheel on. First off, it needs to be of a certain price tag, because if we take for instance Amazon or Tesla or Apple, not everybody has that sort of collateral to sell puts, cash covered puts on those types of stocks, and we don't really ever recommend selling naked puts or even more so starting the wheel with covered calls. I've seen a few guys do that. I really don't think that's a great idea at all, because at the end of the day what we're looking for here would be for us not to have exposure. If you guys get exposure to a stock, let's take Intel for example, because a few months back I remember one of the guys that I was watching on YouTube took exposure on Intel and started selling covered calls. But it's really hard to make any forward progress when the stock moves this way, guys. And if you already got exposure, let's say you bought 100 shares at $42 here, you've got $4,200 worth of collateral that is now tied up in Intel, and you're trying to sell covered calls and you're always kind of on the defense. And I want to turn that scenario upside down. I want to make sure that, again, running with the Intel scenario here, I want to make sure that when Intel is over here at 27, we're selling $25 strike price puts, and the stock moves higher and we keep the premium. We wait for it to retrace, we sell again at 28, the stock moves higher, we keep the premium, and rinse and repeat. I really don't want to get assigned. I think that guys that are teaching you to get assigned when running the cash flow wheel kind of fail to get the point of the cash flow wheel in the first place. And so, you know, it's so hard to come up with really good risk reward and juicy ROI type trades with the cash flow wheel. So I just sent this out to our patrons earlier today. If you guys want access to that, please feel free to go over to Patreon and subscribe. And we do this frequently, guys. We frequently send out recommendations for what puts to sell. For instance, here just in the last few weeks we've sold puts on Peloton when it was at $7. We actually did this twice and we generated premium and kept all of that premium. We did the same exact thing on ChargePoint as well. We sold puts when ChargePoint was at $8, and then when it was at $7.50, we kept both of those premiums almost entirely, and we didn't ever get exposure. Another one that we did exactly the same thing for was MPW, and these are all things that you can back check when you land into our Patreon. In case you feel like I'm full of it here, definitely feel free to run a QA and see if I'm making this stuff up, or if indeed we made all of that premium, all of that money by doing so. And guys, I want to take out the Teledoc example here. It's one single example out of a list of probably 10. I didn't count them, but probably 10 or more. And I made a big point in explaining to our patrons that we only want to focus on generating premium here. We do not want to go for stock appreciation, because again, to my mind, if you go for stock appreciation, you're always going to be on the defense. Plus, check out the ROIs on these ones. Every single row at the end of it has an ROI percentile component to it. This is not an annualized ROI, it's not a monthly ROI, it's the ROI that you're going to make until the expiration date that you can see at the start of the row. So we've got August 11th for most of them, we've got August 4th for the Teledoc example that we're going to look at here. So let's take the TDoc example here, guys. We are looking at a $24 stock here. We are looking at a $23 strike price put, which would mean that we are going to be investing or to be putting up collateral worth $2,300 to enter this put. Now, guys, if we do get assigned, let's take, I always want to take the worst case scenario into account. If we get assigned the Teledoc $23 strike price put, expiration date August 4th, so we have roughly 3.5 weeks up until this guy expires. It has an IV of 71, which is really important. You want to be selling stocks with a really high IV. Now, what's important to note with this one is that it has earnings. This is really important, and it's part of the reason why you might want or not want to get exposure here. You guys do as you want. I don't have any recommendations here really. I usually do avoid taking exposure just before earnings dates, but that's up to you guys to decide. Now, moving back here, guys, we want to take the August 4th $23 strike price put. We're gonna generate almost a full dollar worth of premium, 97 cents. That means that you take the $97, you put it in your pocket, and unless you close out this put for a loss, which I never recommend doing, if you enter a cash flow wheel type sell put position, I always recommend that you guys keep that until expiration or until you can exit by just paying a few cents back on that position. Now, if we do take that, guys, let's pretend that worst comes to worst, Teladoc completely crashes here. It blows through the $23 strike price. We get assigned. It's the 4th of July, the 4th of August. We get assigned, and we need to put up the collateral. So we're gonna be basically assigning $2,300 towards this. But guys, our average cost is gonna be $22.03. That's what we have in terms of average price. And as you guys can see, we have a really significant support area over here that I'm gonna color code yellow as soon as I can find the thing where you can change the colors. I'm gonna color code it yellow. As you can see, we've got a triangle here. It looks like a break above. It looks like we're gonna be moving higher here. And either way, even if we come back to retest this guy, we would still have our average cost below that threshold. And the plan here, I cannot stress this enough. The plan here, let's say that we get assigned the $23 strike price put. We get it, it's ours. We have 100 shares of TDOC at $22.03 average cost. Sell calls immediately. I can't stress this enough. You should sell calls immediately. I usually want to be able to sell calls at the same strike price, so $23 plus, because that's when you truly get to keep all of that premium that you've been generating. And I expect us to be able to generate another roughly 70 to 90 cents of premium if we do sell those calls. So ultimately, between the two different legs of the put and the call that you would have for the wheel, I think you can generate roughly $1.63, which really translates into roughly 7% ROI for what will probably be a 2-month sprint here in case we do get assigned. If we don't get assigned, as I was showing you guys, we are going to pocket 4.2% ROI here in just a little bit over 25 days. I think it's roughly 27 days here. And this is really, just imagine being able to do this month in, month out. This is exactly what we're doing on our Patreon community. Of course, we have Forex trades, we have futures trades. We do a lot of different things, but the cash flow wheel is a really important component of what we do there. Guys, if you want access to the full list, please reach out. Check out our Patreon. I think you need the $50 tier to get access to these. Thanks so much for watching today. Please like if you've learned anything, and I'm gonna catch you next time. Take care.